Let's take an illustration on the principle of double entry. We have a typical question on the board of a sole proprietorship, which is a one-man's business, and then we have the principles or rules that we are meant to have memorized. So let's see how these principles, how we are going to use them in solving questions. It's important to add at this point that whenever you see a question, we should calm ourselves down and analyze the question, familiarize yourself with the question, and then bring to play these principles that you have memorized. And in every transaction, you ask yourself the question, who is receiving and who is giving? Is there an increment in the value of assets, or is there a decrease in the value of assets? Is there a decrease in liability or an increase in liability? Is this an item of expenditure or is there an income? Once we ask ourselves this question to help us in understanding and analyzing the question. So let's go with January 1st. Mr. James started business with 40,000 naira cash. Mr. James here is the proprietor, he's the owner of the business, and he started business with 40,000 naira cash. This value is regarded as capital. And this amount he's using to start the business in cash automatically transcends to the assets of the business. We see that in our accounting equation that your capital plus your liabilities equals to assets. What we say, we have something like capital plus liabilities equals to your assets. That's your accounting equation. In this case now, we have to ask ourselves the question, who is receiving and who is giving? And in this case, we can see that cash account is receiving from capital accounts. The assets of the business is increasing, while capital accounts is also increasing. So January 1st, we are going to look at the effect. For the purpose of easy understanding, we are going to take each of the transactions one at a time, and we're going to look at the effect and the action required. So January 1st, here there was an increase. There was an increase in capital. We are going to have capital accounts. And there was an increase in assets. That's cash accounts. I know at this point you might be confused and you ask, why is it that in this case there was an increase in capital and we had capital accounts, and here there was an increase in assets and we are having cash accounts? The reason is because we're told that he started business with 40,000 naira cash. So that cash automatically is an asset to the business. So we cannot say asset account, we have to regard it as cash account. Next, the action required. The rule of double entry comes to play here. We said we should debit the receiver and we should credit the giver. And we said that capital account is given to cash account. So in this case, we are going to do what? Debit cash account, and we are going to credit capital account. It's as easy as that. January 2nd, paid 450 naira cash for rent. What is rent? Rent is an expense. And in this case, what the principles say about expenses, expenditure, so whenever there's an increase in expenditure, we should debit it. Cash is given to rent. January 2nd, what is the effect? The effect is that there's an increase in expenditure, and that expenditure is what? Rent account. And then there's a decrease in assets, and that asset is cash account, because he paid the rent with cash. Action required. How do we record this in our books? Which account do we debit and which account do we credit? Debit, credit. So since cash is given to rent account, we're going to debit rent account in line with our principle here. It has even made it easy. If you don't want to go, you just remember that an increase in expenditure is meant to be debited. Who is the giving account? That's cash account. Remember the rule of double entry, that you should debit what? The receiver, and you should what? Credit the giver. Next, January 3rd, effect. Said he received refund of insurance, 300 naira cash. We see that our cash account, which is our assets account, is increasing, while our insurance account is decreasing. So what's the effect? There is an increase in assets in form of cash accounts, and there is a decrease in expenditure, which is insurance account. Action required. How do we record this in our books? Insurance accounts give to cash accounts. So debit, credit. So we are going to debit cash accounts as the receiver, and we are going to credit insurance accounts as the giver. January 4th, effects. January 4th, say the proprietor, that is the owner of the business, he puts a further 500 naira into the bank. So this is assets, but in this case, assets in form of bank accounts. So here, there was an increase in capital, and there was also an increase in assets. So there was an increase in capital, that is capital accounts, and there was also an increase in assets. So we have assets in form of bank accounts. Action required. How do we record this in our books? Debits, credits. Bank is receiving, so we debit bank accounts as the receiver, and we credit capital accounts as the giver. January 5th, bought motor vehicle. Motor vehicle is an asset. Previously, we have had assets in form of cash and in form of bank. Here, we are going to have assets in form of motor vehicle. So, he bought motor vehicle, 60 naira, paying by check. Check is a symbol of bank. So, we are going to have bank accounts. What's the effect of this transaction? There was an increase in assets. We're going to have motor vehicle accounts, as I said. And there was a decrease in assets as well. But in this case, because check was used in buying the motor vehicle, the cash or the asset at bank reduced in acquiring another asset, which is motor vehicle. So motor vehicle account is the receiver and bank account is the giver. We are going to have bank accounts. So action required, debits, credits. So we are going to debit motor vehicle account as the receiver, and we are going to credit bank accounts as the giver. January 6th, we had cash sales 1,000. So in this case, January 6th, effects, we had cash sales. And whenever you make sales, and in this case, they are paying instantly, they are not delaying payments. There's instant assets in form of cash accounts. So here, we see that our assets, there will be an increase in assets in form of cash, and there will also be an increase in sales as well. So we'll have increase in assets, so that's cash accounts, and we are going to have increase in sales, that's sales accounts. Action required. So from the word sales, when you make sales, ideally it means that you are giving out something, and so you get something in return, which is cash. In this case, which account do we debit and which account do we credit? Cash accounts, we gave out something and we received something, so cash account is going to be debited, and then as the receiver, and our sales account is going to be credited as the giver.